But after maybe 20 minutes we can have
You
it
can,
and
no problem.
just to reach you.
Okay, no problem, no problem.
Thank
okay.
you.
If you have other questions relating to the finance before I will start with the second part, you can ask. Please free to ask any question relating to the financing, startup, financial rounds. Don't worry, just ask a question. If you have, if not, I will wait and I will start with the second part, which will be a little bit more complicated from the financial perspective, but is important as well. Second part, okay, I will start with the second part, is dedicated to the ESOP, convertible instrument, and dilution. Before I will start it again, I would like to ask you, because I don't know how deeply I'm supposed to go to this topic. Do you know what does it mean convertible instrument, or what does it mean convertible note, or if you ever did you ever heard about term as a safe? It's okay to say no, just to know. Do you know what is convertible instrument or convertible note? No, so sorry, some of them.
I hear it for first time.
Okay, so I will start with the basic at the beginning. So usually when you're talking about investment rounds, we are talking about two kinds of investment rounds. The first one is called prize rounds, and the second one is before the prize rounds or neo equity rounds. So what does it mean prize round? Prize round are typically when you are reading the articles in some newspaper that you can hear that there is an investor which is ready to invest 2 million euro in exchange for some stake in the company. So that's the prize round, because prize rounds means that the investor is already investing the money in exchange for some piece in that company. So the investor already gets some part of the equity. That's a prize round. Why does it call it prize round? Because if you want to get some piece in that entity, you need to already set up the price of the startups. Maybe I will start to go from the beginning. Sometimes the founders are coming to me and telling me, like, if I can explain how does it work, the valuation, okay? And I don't like the term valuation of the startups. I don't know if you have experience by valuation any of the company, but usually if you want to set up the valuation of something, of some asset class, you need to know what is the positive free cash flow which is generating that asset class. It's very complicated, but I will try to explain you by some simple example. Imagine that you are buying apartments, you are buying the house. If you are buying apartment or you're buying the house, what is the value of that apartment? If you are buying, you are not buying it for the value, you are buying it for some agreed price, okay? But what is the value of the apartment? If I want to calculate the value of the apartments, I need to figure out what will be the net income of that apartment, which I will get it if I will rent that apartment to my tenants. That means if I know that I will rent apartment for 1,000 euro amount, I will deduct it some expenses which are relating to these apartments. I can somehow figure out what is the net rental income for these apartments. And if I multiply this income over some period of the time, for example, 10 years, and I will get some information, what is the positive free cash flow that this apartment is able to generate to me as the owner of the apartment. If I know the information, what is the free cash flow, this positive free cash flow, which this asset class, in this case, is generating to me, and I'm dividing it by some discount rate, so I need to calculate what is the current value of the future free cash flow. I can calculate, I can figure it out what is the value of the apartment. But if I am buying an apartment, I'm not buying it for the value. I am buying for the price. And the price and value is something different. Price, how about get it? What is the price of the apartment? Usually you are opening some website and you are searching how much costs the apartment in some particular neighborhoods, or how much costs the apartment in some particular size. And if you look at that, this is the apartment which I really like, the price is better than the apartment which I see somewhere else, I go for it and I buy it. So there is a difference between the price, because its price is something what I am paying for something, and the value is something which is calculated based on the future cash flow. So that's, for example, I say that Bitcoin doesn't have a value, but the Bitcoin has a price, because Bitcoin is not generating future cash flow. Bitcoin has a price, which is the price which are two parties ready to pay to buy, and somebody is ready to sell for it. So the same is valid for the startup. Why? Yeah, we are using the term as a valuation of the startup. We know about pre-money, post-money valuation, but valuation of the startup is similar because it's quite tough and complicated to calculate what is the future value of the startup. Okay, because if I will come to you as a founder and telling, could you please tell me what will be your positive free cash flow in 5, 6, 7, 9, 10 years? Yeah, you can come back and you can shoot on me some numbers, but in the reality, that doesn't make any sense. The probability that the numbers will be correct is very low. So that's why I'm saying we are not talking about valuation of the startup, we are talking about pricing of the startup. And what does it mean, pricing of the startup? So if I come as an investor and I'm ready to pay invest 2 million euro, I need to set up some sort of the valuation. That means we have to agree to what is the current valuation of the startup. And we know two types of the valuation, pre-money and post-money. Again, before I will go ahead, do you know what does it mean, pre-money and post-money valuation? Just let me know, because I don't know if you know these kind of things.
By the way, we have a hand from Kanan.
Yeah.
Yeah, Kanan, go ahead if you have any questions, or you just like.
No.
Oh, okay.
So do you know what is the pre-money and post-money valuation? Just if no, it's okay. Just to let me know.
No idea.
Okay. Okay, so then I will go to the basic and I will go, but it's okay, perfect to know that you don't know about it. So I will give you like example. So imagine that as I already mentioned, I'm investor, I'm ready to invest 1 million euro. We already say that we are doing now the pricing round. That means I really want to get the stake in the company. I want to get part of the equity in the company. So I have to come to you and tell you what is the price of the startup. What is the price of the startup? There are like a couple of the methods how to calculate what is the price of the startup or what is the valuation of the startup. Even I don't like this kind of the term. One method is called VC method. The VC method is like it's based off this pricing method. That means I come to you as an investor and tell you, could you please tell me what is your business model? And you told me, oh, I am trying to develop something which is similar like the Facebook, so some sort of social network. And I will ask you, okay, so what will be your business model? And you told me that I want to have this social network and I will try to have the as much as possible monthly active users, and I will try to generate the income coming from the advertising. So the company will pay for the advertising because they know I have a lot of monthly active users. Okay. So when I have this information, how many monthly active users do you have? I look at the information. For example, I will use the search engine, for example, Google, and I will find out that the company which are similar to your business, were currently bought or plus when the price were currently bought, and the price was calculating like, I would say, should the number 100 multiplied by monthly active users. So or by other business model, is not important how many monthly active users do you have, but it's important what are your sales, what are your revenues. And I, for example, know that if I will have revenues 10 million euro amounts, that the company are buying or selling by two times multiple of the yearly revenues. So if yearly revenues are 10 millions, the price for the company will be 30 millions. If I know this multiple, and if I know that the VC fund is usually VC fund when it's coming to you, usually they don't want to stay with you forever. Yeah, the VC funds are raising the money from the partners, from the investors. They are collecting the money, and then they are searching for the startup, and they are trying to find like 20, 30, 40 startups, and they know that some of them will fail, some of them will be successful, and they want to make nice return for their investors. So, but they will not stay forever in the startup. Usually they stay over 5 till 12 years. Yeah. So imagine that I'm investors, and I said that I want to stay in the startup for 5 years. So I'm trying to figure out what will be the exit price of the startup in 5 years, because I want to exit that business in 5 years. I want to sell my shares in 5 years. So if I know that, if I estimate that the startup will be able to do 10 millions in the revenues in 5 years, and I know that companies similar to these startups are buying or selling by 3 times of the yearly revenues, I know that the future exit price of the startup is 30 millions. That means that's the amount that the company will be probably purchased by the third parties. Okay, probably. If I know what is the exit price in 5 years, I need to know what is the current price. Okay, I need to know how much I want to pay, what is the current price of the startup or current value of the startup. So what I will do, again, I need to discount that future price to the current condition, to the current situation. And that's, they are like, I can go to the details. I can tell you how to calculate discount rates. But what you can easily, how you can easily remember, they are like three numbers. If I'm investor in pre-seed or seed, I'm expecting usually multiple 20. That means I want to, from each of the startup, that the return on the investment will be 20 of my investments. We'll come back to this information. If I'm investing in A round, I will probably expect the 10 times multiple. And if I'm investing in the B round, I'm expecting 5 times multiple. What does it mean? So if I am in seed stage, so you are really like a startup which just has some MVP and are searching for the market fit. If I want to invest 1 million euro, I'm expecting that that's my stake in the company in 5 years will have value 20 million euro. Okay, if I want to sell my stake, I am expecting 20 times multiple of my investments. So back to our example. So if I have a startup which will have an exit price 30 millions, and I'm as an investor investing at the seed stage, what I need to do to calculate the current value of the startup, I take these 30 millions and divide it by 20. It's very like I try to make it simple as possible. And if I divide 30 millions by 20, I end up by the post-money valuation. That's the current value of the startup after the startup will get the money from the investor. And what is the pre-money valuation? If I take the post-money valuation and I decreased this post-money valuation by amount of the what was invested by the investor, I get the pre-money valuation, which is the current value of your startup before the investor will transfer the cash to your bank account. It was understandable? Just so this is the pre-money. So if I come to you and tell you that the pre-money valuation of your startup is 1 million euro, that means that's the value of the startup right now before I will send you the money. If you ask me to invest 500,000 euro, if you add to this pre-money valuation 1 million plus 500,000, you will end up by 1.5 million. That's post-money valuation. That's the valuation of your startup after I will transfer my investments to your bank account. Okay. So this is just to understand how this valuation is work. That's one angle, one perspective. Second is what you have to take in consideration. If you as a founder are searching for the startup, for the investor, you have to take in your consideration the size of the fund. I will tell you like the story, like real one. Imagine there is a very famous like VC fund, Andreessen Horowitz from Silicon Valley. Okay. They invested 250,000 euro to Instagram. That's the real story. 1.5 years probably before, the Instagram was bought by the Facebook for, I don't know, 1.5 billion. I don't know. I will shoot the number. But Andreessen Horowitz made from this 250,000 euro 76 million. So quite nice income. Yeah, you invested 250,000 euro, and in the end you end up by 76 something million euro as a part of the exit price. It was very nice multiple, over 300 multiple. What I'm trying to tell you that Andreessen Horowitz, they were not happy with these investments because they invested just 250,000 euro, but their whole funds, that's the amount which was ready to invest to all of the startups at that moment was 1.5 billion euro. So if they want to cover all the funds, they will need to find like 19 or 20 Instagram or startups similar as Instagram. And as you can see, Instagram was a very successful startup, and it's quite tough to find similar company on the market. So what is this story about? When you are searching for some fund or for VC investor, try to have a look on the size of the funds as well. Because if I am fund, or I'm the manager of the fund, and I'm managing the funds in amount of 100 million euro, for example, or dollars. Usually what I'm doing with this money, I will not take in consideration some management fee and so, but imagine I have really funds in amount of 100 millions. Usually the manager of the funds is trying to invest into the minimum 20 startups, usually 30, 40, maybe 50, okay, but minimum 20. If I have 100 million euro, which are ready for investments, if I want to invest to the 50 startups, my investments on average per startup is 2 million euro. So even if you will come to create idea with a great startup and great idea, and you will search for 200,000 euro, probably they will not be interested in you because of your size, okay? So you can maybe come to them when you are asking them for more money, or you will come on the later stage. And the size of the funds has impact of the strategy, how the VC funds are investing into the startup, but the size of the funds has impact even to the valuation. Because again, if I come, again, I will step in and I will try to tell you how the manager of the funds are thinking. If the manager of the funds has available 100 millions divided by, let's call it 50 startups, so he is ready to invest 2 million euro a startup. He's expecting that each of the investments, what he is doing, will cover his whole fund. That means he's expecting from each of the startup he invested in, from these 50 startup, that each of them will be able to do a return in amount of 100 million. From each of them, they know that probably 80, 70, 80, maybe some of the 90% of the startup will be not successful, okay? They will fail. But they are just searching for this outlier, 1, 2, 3, 4, 5 startups. They will make this return. But these are the expectations what they have from each of the startup. That means if I want to invest 2 million euro to your startup, my expectation is that in 5 or usually 10 years, I will sell the shares in your startup in amount of 100 million, okay? Because my fund is so huge. So if I come to you and try to make a deal with you and I say, I'm ready to invest 2 million euro or $2 million, you know that my fund is was created in amount of 100 millions. So you already have imagination, what is my expectation from you as a founder of the startup. My imagination or my expectation is that in 10 years, I will make 100 million by exit. So if I come to you and tell you, or you come to me and tell me that I am ready to exchange for 2 millions, 15% of shares of my startup. That means give me 2 millions and I will give you 15% of my startup. What I will do as an investor, I will think, okay, so if I need to invest now 2 million euro for 15%, probably there will be 2 next financial rounds. That means they will come. You will raise money in 2 next financial rounds, and probably I will be diluted. That means from my 15%, because due to that dilution, I will end up by 10%. So by exit, probably I will keep 10% in the equity of your startup. So if 10% represent 100 millions, because this is something which I'm expecting from my 2 millions, I will end up by 100 millions. By 10%, my expectation that your startup should be unicorn, because 10% is 100 million. That means the whole startup should have value in 10 years, $1 billion or euro. So this is other like mechanics which you need to take in consideration when you are searching for the investor, how they think. Some of the VC funds will tell you that they don't need to cover like 100% of the fund. It's just sufficient that they will cover just 50% of their fund. In that moment, they can play a little bit the valuation, and the valuation can be even higher. But this is everything impact on it. Okay, and this is the pricing round. This is something what you will deal when you are searching for investor, when they are ready to invest the money in exchange for some equity. And when I come to the convertible instrument or notes or safe or so and so, this is something which has nothing what to do with the equity at the moment which you are getting the money. So at the really like early stage of the startups, it's easy for you to come to the investor and asking them for the money and don't agree on that price for that startup. And it's easier for you to agree, could you please, can I borrow from you the money? Because the convertible instrument, it's so called like sort of the loan, okay? It's sort of the loan which you are getting as a startup from the investor. There is even some interest rate in place, but don't be scared because nobody is expecting that the interest rate will be paid. So you have some convertible loan, you get the money, there is some interest rate, and there are some techniques and mechanics how this convertible loan in the future will be converted to the equity. That means you are getting money as a loan, sort of the loan if you are talking about SAFE. So if you raise the capital in Silicon Valley and you, for example, will establish the company in US, that majority of the investor will come to you and they will not offer you convertible note. They will offer you SAFE, which is shortcut from a simple agreement for future equity. It's like sort of the 5-page document which was created by Y Combinator and is widely used in Silicon Valley because it's standardized documents where you need to add just 2 information. You need to add there like information about the money value, how much the investor wants to invest to your company, and there is the information about the cap, usually valuation cap. So it's very simple document. So it's not equity, it's something sort of the loan. In case we are talking about SAFE, it's not even loan, it's something between the equity and between the loan. And why would you use this kind of the instrument? Because when you are searching for the investor at the beginning, you really need to get the money as soon as possible. So if you sign this kind of the documents, probably in a couple of weeks you can get the money from an investor and you can see them on your bank account. If you want to get the investor and you are in the pricing round, that means you really want that they will invest money in exchange for some equity in the company. All of this is usually connected to the due diligence. What does it mean, due diligence? So usually when the founders are coming to us and they're extremely happy telling us or showing us, we signed a term sheet. Probably you already heard about the term sheet. It's like sort of the documents when the investor and the founders agreed on some particular points, how the transaction is supposed to look like. You have to realize that once you have the term sheet in your head, I don't want to say that means nothing, but you don't have investments in the pocket. Yeah. Usually, when you have this kind of these documents in your hands, the next step, what the investor will do, they will open the due diligence. That means they will put you in touch with the lawyers. They will put you in touch with the financial consultant. They will put you in touch with tax advisor, and maybe they will probably put you in touch with somebody who has technical background. And if you are a software company, they will go through your technical solution and so and so. Only when they are done with this due diligence, and there will be no red flag, something we say no go. This company is not. We are not ready to invest to this company. Then you will sign all of the documents like shareholders agreement and shares purchase agreement, so and so. And then you can say that you have already your investment in the pocket. Okay. So, but that's when you have pricing rounds. When you are talking about convertible note, for example, you just sign the documents. It's sort of the loan. I don't want to say that there is no due diligence, but sometimes there is just very short one and easy one. But you get the money very, very easy. Why? Because you don't want to agree on the price for the startup. Because you just say, I get the money using this convertible instrument, and when the next investor will come, then we will try to convert this loan or this credit to some equity. But this will come in next step in 1.5 years or 2 years. So don't waste the time. Let's agree on this condition and let's do this investment. So that's the difference between the convertible instrument and the equity. Just to let me know if I was clear, because I'm expecting I will tell about these kind of things, but if I hope that it can help you. Just let me know. Some other questions?
No questions.
Peter, I would be thankful if you could drop your email address in the chat box. If you don't forget to leave.
Yeah, okay.
Thank you.
Oh, I just need to know how much do you know about these kind of things. It's extremely important for me because I would like to maybe go to tell you about the difference about the dilution when you have a convertible instruments in the place and you have ESOP plan, but maybe this is something which is like maybe I'm supposed to go more to the basic. That's why I'm asking. It's okay. I just need to know how much do you know about this financing of the startup and so and so.
Personally, I'm in beginner level, so everything is new for me.
And other guys in the group? Do we have some answer in the chat?
No, still not.
Okay. Okay. Other thing which is relating, okay, maybe I will go like really to the basics and I will try to explain. So as I already mentioned, there is difference between the prize round, and this is the difference before the prize round, no equity financial round. So then we are talking about convertible instrument, safe, and so and so. We said I already said what is the difference between pre-money valuation, post-money valuation. That I don't like the term valuation. I would say more about, I would more talk about the pricing, because we are trying to set up the price for the startup, not the valuation, because it's quite tough to say what is the future free cash flow of the startup at the beginning of the journey of the startup. Other things which you need to really know about the financing of the startup is that when you get the investor on the board, it's quite usual that the investor is expecting from you to create the ESOP, employee stock option plans. And there are many of the options how to do the ESOP plan. In some of the countries, the startups are creating just phantom shares option plan. In some of the other countries, they have just option plan. Just to know what does it mean. If I am creating the ESOPs, employee stock option plans, usually I am obliged I oblige as a founder to dedicate part of the equity to the employees, but I'm not giving this equity directly to the employees. So that's mean if I am stock exchange company, I'm not giving them the stocks immediately. Usually I sign with them like sort of the stock option plan agreement, telling them like, hey guys, I'm extremely happy that you are on the board with me or with our founders. I am ready to give you like some piece of the company, and hopefully when it will be successful, we will sell it, all of us, and the exit. When you are talking about ESOPs in Europe generally, the ESOP plan, the targeted like percentage of the ESOP, that means the portion of the company which is dedicated to the employees is around 10%. That means usually 10% is the maximum stake of the company which the founders and investors are ready to give to the employees. Okay, if you are talking about US company, we can end up by 15, sometimes even close to the 20%, but on average 15%. So at the beginning, usually in Europe, as if I come back, when the first investor are coming to you, that they will tell you, just please dedicate part of your company to the employee. So 10% is dedicated to the employees. You are not giving them these shares immediately, but you somehow set up this option plan. What does it mean? You sign the contract, as I already mentioned, and you set up like sort of the vesting. What does it mean? Vesting means that you will release the options to get the shares of the company in future, and the vesting period is usually set up for 4 years. What does it mean? If I am employees and I will come to you as a founder, we make an agreement that you are a key employee for me. I'm ready to give you 2% of the company. Okay, stakes in staking company, 2% stakes in the company. But I will not give you immediately 2%. I will just tell you, if you will stay 4 years, then you will get these 2% or options to get or to buy the shares in this percentage. The vesting means that if you leave the company in 1 year, you will get anything, zero. Okay, that means zero. After 1 year, you are entitled to get 25% from your 2%. So 1/4 from these 2%, and then every month usually your percentage will be slightly increased month by month, and then when you manage to stay in the company for years, you will get your 2%. You will not get them again immediately, because you are holding in your head just options. That means just rights to get the shares for free or for some strike price. It depends of the legislation. So that means Then, for example, in Slovakia, it's quite usual that you are getting the shares for free. So once I am holding the options in my hands, I pass this vesting period. I'm in the company over 4 years. I can come back to my company and telling them I want to use my right. If you are like sort of the stock exchange company, they will issue the new shares, and I will get my shares, which will represent 2% shares in that company. Okay. This is like the classic way, I would say, which is quite used in US, for example, in UK, in Estonia, I would say. But in continental Europe, and I would say that probably we will have a problem in Azerbaijan as well, but I'm not sure. There is an issue with the taxes. And I will try to tell you what is the problem with this kind of the option plans from the taxes perspective. If I am employee of the company, if I get the options, this will not trigger any tax event. That means this is like sort of compensation for me as an employee. So I'm an employee probably because I'm working for the startup. I'm getting a lower salary compared to which I will get if I work for some multinational company. But this lower income is compensated by this option. In US, for example, these options plan are not consider anymore like compensation for a lower salary, because currently there is so much money in the VCs that the startups are really able to pay the employees at the level like multinational company. But still, everybody is expecting to get some shares on the company because they want to somehow participate on the potential success of the startup. So, but the problem is that once you get the option, okay, there is no problem. But once I will change my, or I will change my option, or I will exercise my option. That's the right term. I will exercise the option. I will come to the startups and telling them I want to really now get the real shares. At the moment when I get the real shares, I need to have a look on the fair value of the company at that moment I'm getting these shares. And if I get the shares for free, this will trigger the tax event. That means I have to pay the taxes, eventually in some of the country, health insurance and social insurance as a regular employees, because these shares represent like sort of the bonus which I get from the company. What is the main problem? For example, imagine one of my one of our clients, the startup, was agreed with the employees that they'll get this ESOP, this employee stock option plan, and one of the employees was targeting something around 1% on the equity of this startup. They were quite successful by raising the capital, and recent value of that startup is around 50 millions. Okay, so that's the fair value of the startup. So imagine 1% from the 50 millions currently represent 500,000 euro. So if the employee come now and say to the founders of the company or to the financial department or the legal departments, I want to exercise my options. That's I want to exchange my options for the shares, for the real one. And we agree that I don't want to pay for it because that's sort of the compensation for my work, which I did for the startup for the last 4 years. 500,000 euro will be considered as taxable income. That's the amount that the employee is obliged to pay to tax, which is huge. Paying taxes and contributions for 500,000, it's huge amount, not just for the employee, but in some of the countries, employer are obliged to pay social insurance or health insurance on top of it from this kind of the impact. So this is significant impact on the employee, because they need to pay it from their own pockets, because they are getting shares. They can't sell the shares on the market because they are not a publicly traded company. Startup, you can't go somewhere and sell the shares. You are even obliged, don't do it to the third party, but you have to pay so much money on taxes and contribution. So that's why, and this is something which is somehow settled, for example, in UK, somehow in US, you don't need to pay by this kind of the event taxes. So that sometimes some of the startups, they come back and say like to the employees, do you know what? It will be better that if you not set up the ESOP plan and you set up like sort of the phantom shares. So if somebody come to you and tell you as an investor, let's create a phantom ESOP plan for the employees, that means that you will somehow virtually give to the employees some piece of your company, but not in the reality. So this ownership of the company will not be incorporated in the trade register. So if you open the trade register of the in your commercial court, for example, and you will not see that the shareholder, the name among the shareholders in the company, some of your employees. It will be just a simple agreement between you and company, between you and the employees, that once they will come the exit event, that means once the company will be sold, for example, that employee will be participate on that exit price. That means, what does it mean? Imagine I sell the company for 100 million. I have exactly, for example, this kind of the case, that the company was sold for hundreds millions of the euro. And employees, they were entitled to get 10%. Employees, all of the employees were entitled to get 10% of that exit price. That means, just imagine that I will shoot a number. The exit price was 100 million euro. 10% out of it is 10 million. That means 10 million is the amount which is supposed to be paid to the employees. They are not real shareholders. They have just agreement that they will be treated as a shareholder, but they are not registered in the commercial register. They are not holding any shares, any participation interest in the company. Okay, but they will get this 10% out of it. What does it mean? This 10% is usually in many countries treated as a financial bonus. That means they don't need to pay taxes at the moment when they get these phantom shares, but they need to pay taxes once they will be real paid when they will get the money on the bank account. The problem with this kind of the approach, or by a phantom ESOP scheme, is that, yeah, it's true that you don't pay taxes when you get the shares because you get the phantom shares. The problem is that usually employment income, that means income as an employee, is taxed at a higher level than is taxed the capital gains. So there is like plus and minuses when you are using the ESOP plan or phantom ESOP plan. But just for you at the beginning to know that if investor is coming to you and telling you, okay, I am ready to invest the money into your startup, and this can happen if he's investing via convertible instrument or if he's investing through the equity, they are trying to convince you that partially you have to give up on some shares in your startup, like on behalf of your current and the future employees. And that's the ESOP plan. And there are like two types of the ESOP plans. One is the real one, let's call it, when your employees will be entitled to exchange the options for the real stock. And the second one is the phantom one, when the employees are not really getting any shares. They are just getting some virtual shares in the company, which will represent the percentage they will get out of the exit price once you will be successful and you will exit the startup and sell it to the third party. Or if you want to go for the IPO, that's mean when you will want to be listed as a publicly traded company, they will get the remuneration out of it as well. Okay. What else from the basics? We said what is the valuation, pre-money, post-money valuation. What is extremely important to know? Do you know what are the? Again, I will ask just a maybe stupid question. Sorry for my French. Do you know what is the difference between the stages? Like what is the difference between pre-seed, seed, A round, B round? I briefly already mentioned something about, but do you know what is different about this status by financing, for what you're supposed to use the money when you are talking about these financing rounds? Just to let me know.
Basic information.
Sorry, I didn't understand you. Sorry, like, sorry. Basic, or I didn't hear. Sorry.
Yeah, basic.
Okay. 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 So usually like when you are talking about the pre-seed investments round, we are talking about investments when the founders of the company are using the money to develop this MVP. Okay, this like sort of the prototype which you want to show to the investor in the next round. And if you want to show to your first future potential customer, and you start to test on it if they are ready with it. Okay, so that's the pre-seed round, which is quite tough to get the investor in this pre-seed round, because usually you have just idea, and there are plenty of the people running over the world having the idea, but you have nothing in real. Okay, so it's quite common that in this when you're talking about pre-seed round, as a typical investor, the typical investor are called like 3F. family, friends, and foolish. That's mean usually you are coming back to your family, you are coming back to your friends, or to some foolish or crazy people. They are ready to invest into your startup and trying to collect the money for this kind of the stage. It's quite tough to get the money from the VC funds, but as I already mentioned, because there is a lot of money, especially in the VC sector, and I'm not talking just about Europe, I'm talking about US as well. Even now we are facing with a potential recession, and everybody say that the future looks a little bit bad. There is still a lot of the money, because you have to realize that VC funds are investing the money. They already have a commitment. That means they already have a money promised by the limited partners. So they have a capital which they are ready to invest. Okay, but this is not the stage when when usually VC funds are investing. But because the VC funds are so huge, and lately the funds are really in amounts of the billions of dollars, small VC funds lately they are really trying to step even to this kind of the stage and are ready to invest even to the startup at the pre-seed stage, which was not quite common in the past. Okay, but usually the typical kind of investor by pre-seed are really this family members, friends, and the foolish. Let's call it like this. The next stage is like seed stage. Seed stage is really like the stage when you try to raise the capital in order to get the product market fit. What does it mean? Like you're coming with your products, trying to develop, try to get it on the higher level. Let's call it like this. And you are really trying to come to the customer and trying to realize if they will be interested in that product and if they are interested to pay for that product or for that service. So this is the stage when you are really trying to collect the money to really find out if there is a product market fit. Yeah, as I already mentioned, quite common that at this stage angel investors are coming in place, and angel investors are those that are really investing, or again, as I say, already the VC funds, the small VC funds are ready to invest at this stage. And then you have the A round, which is for me the most important by startup. A round is already the financing when you are getting the money, which you're supposed to use for scaling the startup. You have to prove that your business model is scalable. And this is something which is extremely important for startup, because the main difference between the startup and regular business that the startups are extremely scalable. What does it mean? Imagine like rockets. I'm trying to compare the startup with the rockets. When you are rockets, then VC funds are like sort of the fuel to the rocket fuel, like which is really helping to shoot the rockets into the moon. Okay. So startups are like rockets. That means, what does it mean to have scalable business? Scalable business means that your revenues are exponentially growing fast, but the costs, and especially direct costs, which are dedicated or relating to that income, are not growing in the same way. That's the point that you can say that the business is scalable. I am giving as example, for example, our company. So imagine, as I already mentioned at the beginning, we established the company in 2006. It's a business which is like, it's not scalable, because if you are doing accounting or you are doing payroll, you have to take in consideration that, or I will give you like this better example. Imagine I'm tax advisor. The tax season is coming. That means individuals are asking to prepare the personal income tax return. And I have a statistics, and based on the statistics, I know that if I want to prepare the personal income tax returns, if I have just one in the company, I can do maximum, let's call it 50 personal income tax returns a season. That's the maximum amount of the personal tax return which I'm ready, me as a person, prepare a season in March. We have a tax season in March. So if I want to scale my business, or if I want to expand my business, what I have to do? I have to go to the labor market and I have to hire some new colleague. So if I know that one person is able to do 50 personal income tax return a season, if I want to do 100, I need to hire one person. If I will hire 100 colleagues, I know that I am able to do 5,000 personal income tax return a season. So this is not scalable business, because if I want to grow my revenues, in the same way, I need to grow my personal costs. Okay. The same situation, I am the founder of the startup, offering the solution which is able to prepare the personal income tax return using some artificial intelligence, and I will have some beautiful front end when the customer will just click on some websites, they will pay by the credit card, they will add some information, and the clients will get this personal income tax return prepared by this artificial intelligence and maybe some robots in the backend. Okay, doesn't matter. So this is already startup, because I have a technology. At the beginning, I really need to spend a lot of money to create the front end, to create the back end of that solution. Maybe I need to hire some tax advisor who will tell me all of these rules which are in the place and set up the system. So at the beginning, I really need to invest a lot of money to have this tool ready for sale. But once I will release my solution, I'm done. Doesn't matter if I will have 100 customer, 5,000 customer, 10,000 customer, because there is already solution in the place, which is ready to serve to many customers as possible. And that's already scalable business, because if I will hit the market fit, that means I will really hit with my solution the market fit. There are really customer for my solution. There will be really individuals ready to pay 10 euro per personal income tax return, because they know that if they will go to the real tax advisor, they will pay 100 euro, for example, for personal income tax return. So they are ready to pay 10 euro, and they will not be served by some real person, but some solution. And they are really interested in it because they know that they need to file the personal income tax return, and if they will not do it, they will be fined, and they will get the penalty. So I hit the market fit. I have a solution, and the business is extremely scalable in this moment, because my costs after the solution is in the place will not significantly grow, just the revenues. Yeah, I will need to probably have some people working in the backend to fix some bugs if there will be something going wrong. Maybe there will be some support. Some of the people, they will try to help to the customer if they will not be happy with the solution, or there will be some bugs, or they will need to get some information. But this is a scalable business. And this is the main difference between the startup and traditional business. Both of the businesses can be successful. So as I already mentioned at the beginning, we started as a small accounting firm by 10 people on the board. Now we have over 800 colleagues, but it took years compared to the startup. It took years. Startups are growing extremely fast, and they are not growing just because the investors are expecting this extremely fast growth, as I already mentioned before, but because of it's the DNA of the startup. There is some huge technology behind it, and I really like when I'm comparing to the startup to the dogs. When you look at the traditional companies, for example, when you look at the company as a Disney, I like Disney compared to the Disney. When you look at the Disney as a company, you see that the Disney has already over 100 years history. It's capital-intensive business. That's mean if you want to compete to the Disney, and I'm not talking now about a streaming platform, I'm talking about amusement park, for example. Opening one amusement park will cost you minimum $200 million, and you will go to quickly to 2 billion if you want to open something big. Okay, so it's capital-intensive business. I'm comparing these businesses to the turtles because it's they are growing extremely slow at the beginning, but they will be here for tens of years, maybe hundreds of years, because the life cycle of the company is extremely slow. It's capital-intensive business. Then you have a startup or technological company, and technological company, they have life cycle extremely short compared to this. If you look at the Yahoo, for example, Yahoo was technological giant at the beginning of 2000s. Nobody was even expecting that these giants will disappear. There is no Yahoo anymore. Yeah, we are using Yahoo Financial Services. Some of the people are still using probably Yahoo email. I don't know if it doesn't exist, but probably. But the Yahoo doesn't exist anymore, and it was technological giant because the life cycle of these companies are extremely short because the technology is so fast, and as the company are growing extremely fast, their life is extremely short, and that's why the startups need to grow extremely fast. They need to grow extremely fast, not just because the VC investor needs to get the returns in 7, 8, 9, or 10 years, but because even the life cycle of the company is extremely fast. So that's why it's extremely important by these A rounds, by the financing, to prove that the startup is really scalable, to prove that the revenues can exponentially grow compared to the direct cost, which will not grow so significantly. That's already a sign that this company can be significantly successful because they can make a huge gross margin, and that's why it's quite typical when you look on the successful startup that at the beginning they were in the huge loss. That was the moment when they invested a lot into the tool. They invested a lot to the marketing to get some mass of the customer, and the moment when they hit the profit grows significantly higher. And when you're talking about Facebook, if you're talking about Google, we are talking about Amazon and other companies and so on and so on. Okay. So this is the main difference between the stages as well and how you use the funding. So if somebody will tell you, that we are already facing to the A financing round, that's already startup. They have already some product in the place, some MVP. Probably they hit already market fit. They already have some customer. They're ready to pay for that solution, and now they really want to focus to show that the startup is able to scale the business. Quite usual when you are talking about A round, that the money which the startup is getting from the investor are used to pay the salaries, not just technical stuff, but they are trying to invest money to the marketing stuff. There is already C-level of the management, which is not the same as the founder of the company. So it's these monies are already used to somehow transfer the startup to the classic corporate, what you can see when you are talking about some already huge companies. Do you have some question relating to this? Or tell me something you will be interested in. It doesn't matter, like something which you interesting from the startup perspective or other thing.
I have a question about seed stage and MVP and market fit. What's the difference?
MVP is like the minimum viable product. That means it's some prototype. You have just something like imagine that you are trying to building up some application, or you are trying to build up some software. So you already have like set of the code. You already have something which the customer can use, and you are coming to the customer and trying to test and trying to get some feedback. Market fit, from the financial perspective, I don't want to like it's from the not financial perspective is already like sort of the proof that there are customers ready to pay for your solution. And now it'll be a little bit complicated, but I will try to explain. And the lifetime value of that product is higher than the customer acquisition cost. So what does it mean? So imagine that you have a software and your business model is software as a service. That means you have some solution and the clients are ready to pay for that solution on the yearly basis. Let's say that the clients are paying for that software 100 euro a year. Okay, that's your income, or that's your revenues. How much you are charging to the clients a year? Let's say that I will try to use like really like a little bit simplification, that your direct cost, okay, no, better. I will try to on the accounting part, maybe it will be easy. So imagine again, I'm accounting company. Accounting company is doing accounting. Imagine I have a client, I'm charging for accounting 100 euro a year. It's small accounting, okay, small accounting, small clients. 100 euro means how much I'm charging for my service. Who is doing accounting in our company? Bookkeepers or accountant. That's real people, they are doing accounting. Actually, 50% from each of the euro we are charging, but I'm just shooting the number, but 50% from each of the euro we are charging to the clients, it's spent on the salary costs or personal costs, better say, to the bookkeepers, to the people that are doing really the bookkeeping, okay? So that means if I'm charging 100 euro, 50 euro in our example, it's coming to cover the personal costs, salary costs of the bookkeeper which is doing that accounting. So I remain with this 50 euro. So statistically, I know that the clients our average clients is staying by us on average 4 years. That means I have a client, my average client is paying for the service is €100 a year. I know that the clients on average is staying by us 4 years. That's our average client, and I know that my gross margin is 50%. That means 50% out of my revenues I have to pay to the bookkeepers doing the accounting. Okay, how much remain? It's this €50. If I have this €50 multiplied by 4, which is this 4 years, I end up by €200. €200, it's the lifetime value. That means that's the value which I'm getting of each of my average clients for whole existence of our relationship. It's what every client is paying for all like existence or life cycle or existence of our contract. If I know what is the lifetime value, I need to know how much cost, how much I need to pay to acquire the new clients. So I look at my costs for my colleagues doing the marketing, business development. I look at the cost, how much we are paying for a Google campaign, how much we are paying for a Facebook campaign. I don't know for I make sum all of these costs, and I divide this amount by number of clients I'm getting a year. Okay, so I have some cost dividing by number of clients I'm getting a year. If my what I get is this customer acquisition cost, which I already mentioned at the beginning. So how much I need to spend to get one client a year? In my case, I would say €50. Okay, so I need to spend €50 in order to get one paid customer. In my case, if I know that my lifetime value of average customer is €200 and my customer acquisition costs are 50, if this relationship is 3-to-1 or even more, that's a good indicator that my business model works, and my business is really I will say it like scalable. Okay, I have this market fit. I have already the market fit. Long time I can prove this is scalable is market fit. I can prove that long time I can generate on average clients more than I am spending to getting one client. And this is from the financial perspective definition of the market fit. So I have a customer which is ready to pay certain amounts. I have to compare how much I need to spend to provide that service to a product to that paid customer. And if lifetime value for that particular customer is higher, and ideally 3 times higher than the cost which I'm spending to get the client I can say that I already managed to get a market fit. In simple way, I can say the market fit is the status when the customer are ready to pay for my solution. But I don't like this kind of definition, because I can have a customer which are ready to pay for my accounting services. Let's call it €10 a year. And I realize that I need to pay €50 to get the client. So if the lifetime value is just €10 in 4 years or €40 a year, but I'm spending €50 to get the client, this is not market fit, because from the customer are ready to pay for my services, but I'm paying more to get one paid customer compare how much I'm getting from our relationship. So that's something what I am call it from my perspective. What is the market fit? Market fit is the status when the lifetime value of the customer is higher, the customer acquisition cost, and I am able to keep this status for some significant period of the time. And I really like when this ratio is even 3-to-1 and even higher. So that's market fit. And the MVP is, like as I said, is a minimum viable product. It's something which I can show. It's something which I can already touch. I can show to the customer. I can get feedback on it, and so. Hopefully, I answer your question.
Thank you. And one more question about what's a good time to move scale stage from market fit?
If you scale, okay.
Let's say our product keep in the market, and now we need to scale different regions. Global.
It's a good question. I don't think so there is like general answer to this. Like, honestly, I am a person who likes, and I try to convince the startups grow as much as try to organically grow as much as possible. I come for the money to the investor when you really need it. Okay, and like usually when you have a market fit and you have really like already like certain amount of the clients which are happy for your services, and it is not just about the lifetime. Like, okay, I will come like this. If you need to grow, probably if you need to grow and significantly grow, probably you need to go for money to the investor. If you want to go for the money to the investor, you need to have some like KPI, relevant KPI, which you can show to them. What does it mean KPI? When the startup is coming to us, they are asking us, okay, what are the relevant KPI which we're supposed to show to the investors? And if you want to show to the investor the relevant KPI, first what you need to know, what is your business model. When I don't know how many. In the reality, I really don't know how many business models are there at the moment. But actually, they are saying that currently there are like 9, 10, or 11 business model. And if you don't know how to fit in these kind of boxes of the business model, there is a high chance that you are trying to build something which is absolutely unique. But so that's not important now. So first of all, you need to know what is your business model. What does a business model? Software as a service, subscription model, e-commerce. There are marketplaces, advertising business. I don't know. So first, you need to find out what is your business model. For each of the business model, there is different set of the KPI. So for example, when I am looking at that advertising business, social networks, for example, what will be the critical KPI I need to follow? I need to know what are the monthly active user, what are the yearly active user, for example, what is the login. If I am searching for, when I'm in e-commerce, I need to check what is my gross margin, what are my monthly revenues. When I'm looking at marketplace, one of the indicator will be what is the retention rate. That's mean how many clients are coming back in some given period and buying the product and service via my marketplace again. If I go to software as a service, I will probably look at the churn rate. That's mean I will try to investigate how much revenues I'm using month to month. That's how much money I'm losing. That because some of the customer make decision to stop to pay for the service. If I'm looking on a subscription model, I will look on the churn rate, but I will not be interested in amount, how am I losing on the monthly basis on the revenues, taking consideration customer who left. But I will check how many clients, like physical clients, are lost. And there are these KPIs. And if you have a good KPIs, that means you have good KPIs which you can show to the investor. I think that's the right moment when you can come to them, knock on the door, and tell them, "Hey guys, I have already the startup here. Look at it. I already have a market fit. I can show you that my lifetime value is significantly higher compared to the customer acquisition cost. I can prove that this is already valid for over some period of the time. I can show you my KPI. You can see here is the retention rate. Here is very good churn rate, and I would like to scale up. I would like to try to enter some other market." And I think that's the right moment when you go for the investor. But it's I don't say that there is some general answer to this question. This is how I will do it if I will go for money to some investor, especially when you're talking about a round.
Thank you for this information. Thanks a lot.
Do you have some other question? Somebody? No? Okay.
No, I think we can continue.
Okay. Other things. Sorry?
Just to be sure that we're still on the slide with the blue background, and in the middle we can see the text. What is the relationship between ESOP, right?
I know, but I don't know if I should go. I don't know
No
if I'm
worries.
supposed to go for it because it's really like this will be quite tough topic. That's I'm scared to go for it because it's quite tough topic.
No worries, no worries. Just for confirmation.
Okay.
Go ahead.
Okay. Yeah. Other things maybe because when you're supposed to start it from the scratch, I would like to mention maybe already some of you see there is I'm now it's pity because I don't have this picture. I'm supposed to edit here. There is some beautiful pictures when you can find out and you can find out the picture if you put to Google, for example, how to build up the $100 million or euro startup. I don't know. Does somebody see this kind of the picture somewhere on the web? I don't know if you look at the picture, you can see there like some of the animals. You can see there elephants. You can see there some deers. You can see there some rabbits. You can see there some. I think there is a mouse, and you can see some flies. Does somebody see this kind of picture on the internet?
No, I don't see.
Okay, no, I don't have it here because I didn't. But this is. Sorry, I will just this, but you don't have this. I will just search this. Why I'm talking about this kind of the picture? Because it's other things which we are trying to what we are trying to discuss with the startups when they are coming to us. This picture is telling like story, like there are like 5 ways how to build up a startup which will have value 100 millions in revenues. And as I already mentioned on the picture, you can see like 5 types of the animals. There is elephants. There is like this deer. There is the rabbits. There is the mouse, and there is the fly. And all of these animals are representing like 5 types of the customer. And I will try to just describe what you would see on that picture when I will show you. On that picture, you can see, for example, that elephants, and the elephant is representing the clients, which is ready to pay for the solution of that startup yearly 100K. That's mean $100,000 on 100,000 euro. And the picture is beautiful because it's showing you that if you want to build up the startups, which will be able to generate the revenues in amount of $100 million or euro, you need to have roughly 1,000 this kind of the elephants in order to manage to get to meet that goal. So if I will find 1,000 clients ready to pay 100,000 euro or $100,000 a year, I will be able to develop the startups which is able to generate 100 millions in revenues a year. It's just description, but it's extremely important. On opposite, you have there like this mouse, the fly. That's mean the flies represent the customer, which in the reality is able to pay maximum like 10 euro a year. Usually when you want to, like, you imagine that when you want to have, if you want to really build up the startup which will have a turnover of 100 millions euro, you will probably need 10 millions of this kind of the user. And when I'm talking about this, because each of these animals represent different kind of the customer. So if I'm talking about these flies, so usually, as I said, there is a customer which is not in the reality paying 10 euro, but usually these kind of flies are representing startups doing a lot in the advertising business. That's mean if I have great websites, if I have great social network platform, I am trying to attract as much people as possible to use my application. Facebook is trying to attract to people to use the Facebook or Instagram. Google is trying to attract the people to use the Yahoo or other solution. The main goal is to have there as much as possible, as much people as possible, in order to generate the income in form of the revenues. And these 10% the user are representing the revenues which the startup is generating from this platform. A user, in the reality, the users are not paying for that advertising. So once you open the YouTube and you are watching some videos, in the middle when there is some sort of the advertising, this is something which is paying this is the paid advertising, and this is the income of that startup. Let's call it like this. If I'm talking about different kind of the startups, like I said, there are some mouse Takes, for example, mouse. The typical example, which is representing mouse as a customer, are customer using, for example, platform as a Netflix. So the user of the Netflix are spending $100 or €100 average, and this mouse is representing clients of the startup, which you can describe as a startup. They are working in subscription models. So that's not important, because if I go one step more, if I look on the rabbits represent the clients. They are spending €1,000 a year, and if I look at the deers are the clients which are representing the clients ready to pay €10,000 a year. Again, I would give you like sort of the example why this kind of the definition of the customer is extremely important for you as a startup. When the founders are coming to some of the founders are coming to us, and you ask them the question like, could you please tell me what is your typical customer? Some of them are saying everybody who is ready to pay. That's the wrongest answer, especially when you are even in front of the investor telling them that you want to accept to everybody who is paid for your solution, and you don't have like you don't have like some sort of the model of the typical customer of your startup. For example, if somebody will come to me and telling me, could you please tell me what is your typical customer? And I will come back to that picture and I will tell them my typical customer are deers. That means my typical customer is customer which is ready to pay around €10,000 a year and even more. That means the clients in certain volume, in certain size. I am not really interested in elephants. That means I am not really interested so much in the company which has huge size, like for a company, and we are working for this kind of company. We have a company which are ready and paying us yearly 100, 200,000 euro for our services, but I'm not targeting them. That's mean, by the way, I'm sorry, if you hear some snoring, my dog is snoring under my chair here, okay? So I'm not targeting this kind of the clients, okay? Because elephants are too big, okay? And because they are too big, these kind of clients are extremely demanding. It's great to have a clients as IBM, okay? It's great to have a clients as Amazon, and we are providing the services to them as well. But these kind of clients are extremely demanding because they are big and they are aware of it that they are too big, okay? And so that's why we decided that we will target to the deers. Sometimes we are lucky and we are able to get as a clients the elephants, but this is not our main goal. Our main goal is targeting the deers. And the same is valid for the startups. If you are a startup, you need to know what is your target market. What are the customers you wanna get? If you come to the investor and tell them, okay, I have great solution. That's mean I want to get as a customer somebody who will be described as an elephant. That's mean I have a solution that somebody is ready to pay for it 100K a year. In that moment, you have to realize you need to have extremely great product. If you have a great product, then somebody is ready to pay for that service or for that solution. Nobody will pay you 100K for something which is not technically great. What is extremely important to know that once you are trying to target clients as elephants, your go-to-market strategy doesn't need to be so I would say it sophisticated. The go-to-market strategy is not sophisticated in that case because everything is running just around the product. So if you come to the investor and you are able to prove them that your product is great, you have a product that somebody is ready to pay for that solution 100K and more. Probably if somebody will ask you what is your go-to-market strategy, you don't need to tell them that you need 200 or 300 or 400,000 or 1 million euro, let's call it like this, to spend on the online marketing. Because in that case, when you have a great product, which is extremely expensive, you just need to hire a couple of professional sellers. You need maybe 1 or 2, which will fly over the world and trying to offer the products to the big clients or big company, which are the only one which are ready to pay for your service. So your go-to-market strategy in this case is extremely simple. Go-to-market strategy is just hire some really professional sellers. You have to pay them very well. The people will travel over the world, knowing very well the product, showing to the products and selling to the customer. Opposite, if you are trying target to the market, which is close to the flies, let's be honest, Facebook, except maybe the algorithms which are behind it, it's not some significant technological great products. Okay, it's more about marketing than about technological background behind the products. In that case, when you are coming to the investor, they will be interesting. What will be your go-to-market strategy? What are your experience how to get the clients? Because when you are trying to target the market, which is huge, and there is like a lot of individuals which will be direct or indirect to pay for your service or for your solution, you need to be extremely good by this go-to-market strategy, how to do it. So in the first case, when I'm talking about great products, you just need to hire people that will travel over the year and sell the products. Once you are talking about online marketing, you need to be extremely sophisticated. How you will be able to don't pay so much money to keep your customer acquisition cost to very low. So this is something which we are trying to on which we are trying to work with the founders that are coming to us as well. We are trying to find out what is their typical customer. When we know what is their typical customer, we need to find out what is the right go-to-market strategy. And you have to realize, once you have a great product, your go-to-market strategy doesn't need to be extraordinarily great. On the opposite, if you have a product which is technologically not so great, because that doesn't need to be, because the problem you are trying to solve can be solved by this simple solution, you need to be extremely good at the way how you will go to the market, how you will get that mass of the people willing to pay and willing to use the product. And this is something which is crucial when you are talking to the startup at the beginning of the journey as well. Okay. And I think that's all. I don't know what to tell about more. But I'm ready for a question if you have some.
Yes, guys, go ahead if you have any questions. Just 6 minutes left till the end of the workshop, so let's use this time for you. Try to turn on my camera. The quality is not good because I'm using my other computer. That's
Thank you very much. Thank you very much, Peter, for the detailed, excellent presentation. Nevertheless,
in the end, I was talking about something else that I prepared, but okay.
When you were talking, I just remembered one lecture from our university times when one of our professors showed us 2 samples of Google window and the Yahoo window with lots of details with a messy visibility, and he asked us which one would you choose, because one was like a Google's page, only one place just to write and search something, and messy Yahoo page. And it was the definite answer was of course Google.
The problem of the Yahoo that the solution was obsolete, and I will not say that they did something wrong. I had a problem. I don't have, okay. Or for example, the same problem will face the same problem will be faced by the current the tech giants. I would say they need to realize that the life cycle of the company is quite short. And if you look at the company as a Facebook or Alphabet, even they are already matured company, and even they are not older than 15 years. The question is, in a couple of years, there will not come somebody else and they can be replaced. Maybe we can imagine that somebody else will use something else as a Google, but you have to realize that if Web 3.0 will come here, maybe there will come other searching engine working on different technology which can replace even the Google. So this is something which you have to take in consideration when you are building something, when technology is in the place. Maybe you are building startup which will be here on the market 7 till 12 years, and then you simply need to accept it that the solution is obsolete, and you just need to hope that you will make the right nice exit, or you will be able to squeeze that company and pay out as much dividend as possible. Nobody knows. Like, I would say that technological company in general has really like short life cycle. We don't have experience in that because before we were just get used of the company. They were here for years and years, and they were working in this traditional industry. But I still think that more and more we will see that the technological company will be here with us not forever. The same like Yahoo, they will be bought or replaced by somebody else, but nobody knows. Yeah.
There is such a saying that without any data, something said it is just an opinion. But anyway, for me, Yahoo is completely losing the concurrency against Google in like a searching.
But by the way, do searching. There is only one Yahoo in the world which is currently using as a searching engine, and it's do you know in which country? In what country they're using Yahoo as a searching engine as the most searched service?
Israel, maybe.
No.
No.
Japan. It's only one country. Yahoo Japan is the only one country when the people are still using Yahoo as a searching engine. In the rest of the country over the world, the Google is in place and clear number one.
Interesting information for me.
Nobody knows why. Nobody knows why, but it's just one country.
Okay, more questions?
Thank you very much for both of you, for all of you, and you have lost lots of energy today, I think.
We have to have also.
Yeah.
Hey, if there are no questions, I just want to say once again, Piotr, very thank you for your presentation, for being with us, and for your time. It's as I said before, it's quite rare opportunity to get such quality knowledge and from very experienced person as you. All was clear, super clear, understandable, and I will transfer this presentation to the startups right away after the 2 days of the bootcamp. In this way, I will ask Peter to send me this presentation today or tomorrow. And in advance, I would love to invite you to the demo days that will take place in the middle of December. And you will perform as a jury member, the person who will responsible for the vote of startups, of 10 startups that will be selected to the demo day. And in any case, I will provide you all information and instruction regarding the demo day, and we'll be in touch. And thank you for your your contribution to this workshop. It's really valuable information.
Thank you for having me. Okay, I'm
Thank
keeping
you.
my finger frozen. Hopefully, all of you will be able to raise the capital and you'll be successful. Statistics and something else, but at least 1 or 2 of you, if you'll be successful, it will be great.
Yeah.
Okay.
Thanks.
Thank you very much. Thank you.
Thank you.
Bye.
Bonsoir.
See you
Bye.
tomorrow, guys.
Ciao.
Bye.
Bye. Goodbye. Thank you.
Thank you.
All right. See you later.
Tomorrow. We'll see tomorrow each other.